For years, the phrase smart risk in business usually meant bold expansion, aggressive investment, and big strategic bets. If a company was willing to move fast, borrow heavily, and chase market share, it was often praised as visionary. Playing it safe was seen as hesitation. But in today's economic and competitive environment, that definition has changed dramatically. Businesses are redefining what smart risk means, and the shift is reshaping how decisions are made across corporate America. The old version of smart risk was built during a period of relative stability. Interest rates were low, capital was widely available, global supply chains were efficient and predictable, consumer demand followed clearer cycles. In that environment, taking large risks often paid off because the cost of being wrong was manageable. If a strategy didn't work, companies could refinance, restructure, or pivot without catastrophic damage. Today, the margin for error is much thinner, interest rates are higher, which makes debt more expensive and reduces financial flexibility. Demand patterns are less predictable, with consumers and enterprise clients adjusting spending quickly. Geopolitical tensions affect trade routes and supplier access. Technology is evolving rapidly, especially with artificial intelligence reshaping cost structures and competitive advantages. All of this means that one miscalculated move can weigh on a company's balance sheet for years. As a result, smart risk is no longer defined by size or boldness. It is defined by resilience and adaptability. One of the clearest examples of this redefinition is capital allocation. In the past, companies might commit massive sums upfront to new factories, new product lines, or major acquisitions. Today, many businesses are structuring investments in stages. Instead of building full capacity immediately, they expand in modules. Instead of acquiring an entire company outright, they may take a minority stake or form a strategic partnership first. This phased approach allows companies to test assumptions before fully committing capital. It reduces exposure if conditions change. The goal is not to avoid risk entirely, but to design risk with built-in flexibility. Boards and CFOs are playing a stronger role in this process. Finance leaders are stress-testing proposals under multiple scenarios. Projects are evaluated not only on projected returns in favorable conditions, but also on their ability to withstand downturns. A project that looks highly profitable in a strong market may be rejected if it creates vulnerability during slower periods. In this new framework, smart risk includes asking tough questions up front. What happens if revenue underperforms? What happens if costs rise unexpectedly? How quickly can spending be reduced without damaging the core business? Another major shift involves supply chains. For years, efficiency was considered the smartest strategy. Companies optimized for low cost and minimal inventory. Just-in-time systems reduced storage expenses and improved margins. But repeated disruptions exposed how fragile that model could be. When shipping routes were delayed or key suppliers shut down, entire production lines stalled. Businesses learned that maximizing efficiency at the expense of resilience can turn into a significant liability. Now, smart risk often means building redundancy. Companies diversify suppliers across regions. They maintain strategic inventory buffers. They invest in nearshoring to reduce exposure to geopolitical tension. These decisions may slightly increase operating costs, but they lower the probability of catastrophic disruption. Labor strategy has also evolved. During previous growth cycles, aggressive hiring was seen as a smart risk to capture opportunity. Today, companies are more cautious. Workforce expansion is often tied to clear productivity gains or long-term demand visibility. Many firms are investing in automation and cross-training employees to create flexibility. Instead of building large fixed teams, they design organizations that can scale up or down more smoothly. This reduces the risk of painful layoffs during slowdowns and helps preserve culture and morale. Technology investment illustrates another dimension of the redefinition. Companies are still spending heavily on AI and digital infrastructure, but expectations are more disciplined. Leaders are demanding clearer paths to return on investment. Experimental projects without defined business impact are facing greater scrutiny. Smart risk in technology now means focusing on applications that improve efficiency, forecasting accuracy, or customer retention rather than chasing hype. Innovation remains important, but it is tied more closely to measurable outcomes. Investor expectations are reinforcing the shift. Markets have become less tolerant of aggressive projections that are later revised downward. Companies that provide stable guidance and meet or exceed modest targets are often rewarded more consistently than those that promise rapid growth but deliver volatility. This dynamic influences executive behavior. Overpromising is no longer considered ambitious, it is considered risky. Managing expectations carefully is part of smart risk management. Another area where the definition has changed is geographic expansion. Entering new markets once signaled confidence and scale. Today, businesses evaluate regulatory, political, and currency risks more carefully. Global expansion is approached with deeper scenario analysis. The same is true for mergers and acquisitions. Large transformative deals carry integration risk, cultural risk, and financial risk. In a volatile environment, these risks are magnified. As a result, companies often prefer smaller bolt-on acquisitions that complement existing capabilities without overwhelming the organization. Energy and infrastructure constraints also shape how smart risk is defined. Companies that rely heavily on data centers or manufacturing must account for power availability and regulatory standards. Expansion plans now consider infrastructure bottlenecks as seriously as market demand. Importantly, redefining smart risk does not mean becoming overly conservative. It means aligning ambition with durability. Companies still pursue growth, they still invest in innovation, but they structure those investments to preserve optionality. They maintain stronger balance sheets, they diversify revenue streams, they design cost structures that can adjust to changing conditions. This mindset reflects a deeper cultural shift. Executives increasingly acknowledge uncertainty as a permanent condition rather than a temporary phase. Strategy meetings focus not only on upside opportunities but also on downside protection. The new smart risk calculation balances potential reward with systemic stability. It values flexibility as much as speed. It treats resilience as a source of competitive advantage. In many ways, this redefinition represents maturity. Businesses have learned from repeated disruptions that boldness without preparation can backfire. Sustainable success requires absorbing shocks while continuing to operate effectively. Ultimately, businesses are redefining what smart risk means because the environment demands it. Volatility is higher, capital is more selective, technology cycles are faster, stakeholders expect transparency and stability. Smart risk in this era is not about betting everything on a single transformative move. It is about building organizations that can navigate uncertainty while still progressing toward long-term goals. The companies that succeed will not necessarily be the most aggressive, they will be the most adaptable. They will take calculated risks, structure them carefully, and maintain the flexibility to adjust when conditions shift. That is the new definition of smart risk, and it is reshaping the playbook for modern business strategy.